Welcome to Investors Insights. Our topic today, consumers, cars, and gasoline. How do you come up with that combination? Well, we're here today to tell you, and I am honored as always to be with my distinguished colleagues, Bobby Norman and Trey Booth. We've just come out of a great portfolio strategies meeting. The data was flying, we were nerding out, and I thoroughly enjoy these meetings as we have debate and discussion. It was determined that we need to focus on consumers, cars, and gasoline. And you're getting ready to find out why. So, Bobby, start us off because these are indicators. I like to say this is boots on the ground research. These are things that people in day-to-day life can pick up on. So go ahead and talk about it.
Yeah, it's no secret. We've been enjoying an overall strong equity market. But as always, we're looking at our leading economic indicators. And one thing we looked at is the strength of the consumer and robust consumer spending has been a key driver of not only the economy, but also the equity markets in the last 12 months or so. So as investment managers, we always look for cracks that are starting to show in the economy. And one of those potential cracks is around consumer spending. And more specifically, the durable goods order report that came out last week. So as you can see in this chart, durable good orders fell by 6.1%. Which is the biggest drop in nearly 4 years.
Wow.
And when we talk about durable goods, we're talking about items that last more than 3 years, such as dishwashers, refrigerators, washers and dryers, usually consumer goods that cost more than daily items. And so we follow the durable good orders because it has historically been a good barometer for how consumers are feeling and can kind of serve as a proxy for the overall economy. So we'll continue to watch this carefully as the lower durable good orders report came out last week at the same time as the consumer confidence index fell as well. So again, we'll be analyzing other consumer reports to see if this is a short-term blip or what looks to be a longer-term trend that could impact the economy and the market. So something we're looking at carefully here.
That's great information. Like you said, it's products that our clients are out there buying, and as well as their friends and family. And then Trey, you came in with great information in terms of transportation, or in essence, cars and gasoline. And again, people can feel the impact of these. So talk about that in relation to what Bobby was saying.
Yeah, Greg, thanks. So the automobile is something we watch closely because it's, for most people, it's their second largest purchase in their lifetime behind the home. And so it's very impactful on individuals' balance sheets. And since COVID, the cost of the average car has skyrocketed. The average cost of a new car is $47,000. That's up about 33% from 2019. But the good news is that we've started to see that come down. Barron's created a proprietary, what they call a vehicle affordability index. In the 2019, it was at 56. And what this is, it's a combination of wage growth, interest rates, and new car prices. It started at 56, went all the way up to 66 in December of 22, and now has dropped back down to 61. So what does that mean? That means the average new car price is down around $3,000. We've seen interest rates come down a little bit. And so the car buying public is starting to see some relief as supply chains kind of come through, and then as the new car market rolls over. The downside is that may not shift all the way down to the used car market. Barron's estimates, due to the reduction in car sales from 2020 to 2022, that there's about 10 million what they call missing cars on the market, cars that would have been purchased and available in the resale market that were never purchased, never built. And so that's probably continuing to put upward pressure on the used car market. But with how large of a purchase it is, this is a very big driver in the economy. It's great to see any kind of relief with prices coming down. On the downside, though, we are expecting to see oil prices go up. OPEC announced over the weekend that they're extending their $2+ million barrel per day production cut all the way through June. And so we saw the oil market react higher recently to that. So your car may be cheaper, but it's going to cost you more to get there to buy it. So kind of, as always, a balancing act. There's no absolutes. It's always one where, it's a little bit good, a little bit bad, but it all impacts, at the end of the day, the markets and the consumers.
Yeah, no, and that's excellent insight. It's also why we use the word navigate around here, because you have to navigate through this kind of economic information to watch the trends, see where things may go. And so, folks, this coming summer, although we're in March right now, we still have some time, but you may see gasoline prices up. and that impacts your wallet. Simultaneously, we're watching how the Fed continues to react to inflation. We know you've felt the impact of that. We're watching it in relation to your portfolios and your financial blueprints here at Five Plan Partners as well. We thought this was great boots on the ground research to send to you today, just to give you a better understanding of the type of information that we're constantly reviewing. And on that, we're also going to continue to communicate with you through these blogs, through the events that we host, also on social media, Facebook, LinkedIn, Twitter, YouTube, on our podcast. We love your feedback. We love when you're sharing it with friends, family, neighbors, colleagues, and thank you for doing that. That has opened up doors for us. Also, some of you have asked about me speaking at events, and I thank you for that opportunity as well. The year is moving fast. I can't believe we're in March, the last month of the first quarter. We're going to keep you updated. We thank you for believing in us, and just know that every day here at Five Plan Partners, we strive to make our clients' lives better, richer, fuller. Have a great week.